Hey everyone, welcome back to the channel. Let's get straight into it. If you invest into the S&P 500 with stocks like SPY or VU, then you're buying the entirety of that index, all 500 companies, which is great and there's nothing wrong with that. But what most beginners don't realize is that there are ETFs that follow specific companies within the S&P 500. So instead of owning the entire index, these ETFs focus on companies based on different factors like growth, momentum, quality, dividends, or even low volatility. So today we're going to walk through 5 ETFs that focus on a different slice of the S&P 500, and I'll explain what each one is actually trying to do. And as always, this isn't financial advice, just breaking down how these ETFs work so you can decide what might fit your strategy. If all that sounds good, make sure to stay tuned. First up, we got SPYG, which focuses on the growth side of the S&P 500. See, this ETF tracks the growth companies inside the index, meaning businesses that are expected to grow their revenue and earnings faster than average. Because of that, SPYG tends to hold on to a lot of companies in sectors like technology, communication services, and consumer discretionary. You'll typically see companies like Apple, Microsoft, Nvidia, Amazon, and even Meta heavily represented in this ETF. So instead of owning all 500 companies, SPYG focuses more on the growth side of the market. The trade-off is that growth stocks can sometimes be more volatile, especially during market pullbacks. But during strong bull markets, growth stocks often lead the way. Next up is SPMO, which focuses more on the momentum side of the S&P 500. See, momentum investing is based on a simple idea. Stocks that have been performing well recently tend to keep performing well, at least for a period of time. So SPMO selects S&P 500 companies that currently have the strongest price momentum. That means the holdings can change more frequently compared to something like a traditional index fund. Instead of holding companies permanently, the ETF rotates into stocks that are trending upward. The goal here is to capture market leaders while they're outperforming. But because momentum can shift quickly, this strategy can also be more active and sometimes more volatile. Next up, we got SPHQ, which focuses on quality companies inside the S&P 500. Quality investing typically looks for companies with strong balance sheets, consistent earnings, and high return on equity. These are generally businesses that are financially strong and well managed. Because of that, quality ETFs often include companies that have stable cash flows, durable business models, and long operating histories. SPHQ tends to hold on to companies like Apple, Microsoft, Visa, and other highly profitable businesses. So instead of chasing growth or momentum, this ETF focuses on financial strength and consistency. For a lot of investors, this is often seen as a middle ground between growth and stability. Now, at number 4, we're going to talk about SPLV, which focuses on low volatility companies inside the S&P 500. The ETF selects the 100 least volatile companies inside the S&P 500 based on historical price movement. In simple terms, it tries to hold companies that have historically had smaller price swings. Because of that, SPLV often ends up with heavier exposure to sectors like utilities, consumer staples, and healthcare. These industries tend to be more stable during market downturns. The goal of this ETF is to provide S&P 500 exposure with less volatility than the overall market. But the trade-off is that low volatility stocks can sometimes lag behind during strong bull markets. And last but not least, we got SPYD at number 5. This one focuses on the highest dividend-paying companies inside the S&P 500. This ETF selects around 80 of the highest yielding stocks inside the S&P 500. Because of that, the portfolio often has strong exposure to sectors like real estate, utilities, and financials. These industries tend to produce higher dividend yields compared to the broader market. So investors often use SPYD when they're looking for income from the S&P 500 rather than pure growth. But it's important to remember that high yield doesn't always mean a better performance. Sometimes higher yield exists because the stock prices have struggled. So this ETF is more focused on income generation rather than long-term growth. So each of these ETFs are connected to the S&P 500 index, but each one has a different strategy that they're trying to achieve. With SPYG, you're looking at growth. For SPMO, you're looking at momentum. For SPHQ, you're looking at quality. For SPLV, you're trying to achieve low volatility. And then for high dividends, you're looking at SPYG. Each one is simply filtering companies within the S&P 500 in a different way to achieve a different goal, which means depending on your investment strategy, you could tilt your portfolio towards factors that you prefer. Now, personally, I think broad index ETFs are still one of the simplest ways to invest, but understanding these types of ETFs helps you see how different investors sometimes adjust their exposure inside the same index. Anyway, with all that said, if you've enjoyed this content or got some value, then please make sure to like, share, and subscribe for more beginner-friendly content like this, and I'll catch you in the next video. Take care.